Hello, everybody. October 12th here, right at noon, and welcome to this week's Market Huddle. Wanted to talk this week about the four things or the four tax planning mistakes that we oftentimes see that can end up wrecking a retirement. So that's what we'll spend some time on here today. Couple housekeeping items. We are right in the mix of a move here at Secure Retirement Financial. Many of you already know that we are going to be moving basically to Excelsior Boulevard and Highway 100, just a couple miles south of where we currently have been for the last 10 years. And that's going to be going on Wednesday. So they kicked me out of my office because we had some things with the move going on there. And so I'm coming in from one of the conference rooms here today. So with that said, we've got these four tax planning mistakes I'd like to make sure that we don't make. It can end up wrecking a retirement and what have you. I know that a lot of you are coming to us maybe for the very first time. Somebody that's an existing client of ours may have forwarded the invitation to this. Or maybe you've been watching every week since March 23rd when we started doing these right at the market bottoms. It's crazy how much the market has recovered so far, and I know that a lot of us have concerns of what could be going on here over the next a little less than 20 days with the election. If you have questions, whether you're an existing client, if you have maybe if you're not a client but you've been watching these, or maybe this is the very first time, I want to make sure everybody knows that we are open. I want to create value. Schedule a 15-minute phone call with one of our advisors here, and let's make sure we find the number one action step you can be taking regarding your retirement planning to make sure that you're in great shape. So I'll let everybody know how they can do that here in just a few moments. But if you'd like, you can always call the office at 952-460-3260, 952-460-3260. Keep in mind our address is changing. Everything else is staying the same. Our phone numbers and what have you. So with that said, happy Monday here, Galen. Let's go ahead and dive on in here and go through these. So as you're aware, we've been showing the same disclaimer slide here every week since the last 6 months. I'm not a CPA. I can't interpret tax code. We don't write estate documents. We're not attorneys. Sometimes we'll be talking a little bit about tax planning. A little bit of tax planning is going to come into today. And keep in mind that, the information here today is for informational purposes. Please don't take anything we say as an actual recommendation until we have an opportunity to sit down and give you that recommendation on your own specific situation. So what is the first area that we want to be looking at? Well, the first biggest mistake we see, it's expecting that taxes are going to go down in retirement. I want you to think back here for just a moment. Go back to 1980 something or 1990 something. You were working and somebody's pulled you aside and said, okay, what you need to do is you need to start setting aside money from your paychecks and putting them into this 401k. And remember how this all worked. The 401k was a plan that was going to be replacing your pension. It was important that you set aside money into this so that you could fund your retirement. Now, at that time, I believe they told us the number one lie that they've told to an entire generation, and this is how it went. While you were working, you're going to defer a certain amount of income into this account. That account is going to be, or the taxes on that money will be deferred while you were in a higher tax bracket. The benefit is that when you take the money out, you will be in a lower tax bracket. And yet, literally tens of thousands of boomers are retiring every day right now. Tens of thousands of people are waking up each and every month and realizing maybe for the first time that the money that they're pulling out of these retirement accounts is really not being pulled out at lower rates. It's being pulled out at higher rates than what they averaged putting the money in. That means that we have to start to do something. We've been told this for decades, and I want to share with you that right now taxes are at 40-year lows. I'm absolutely convinced that we know the tax rates are going to expire here in 2026, January 1st, 2026, the end of 2025. And I think that there will be literally millions of Americans are waking up and they're going to realize they squandered one of the best opportunities we've had in over 40 years for getting untaxed from some of these accounts. Last year at this time, the government was running at 100% of their spending of the GDP went into debt or the deficit. Now we're at 130 to 140. We're spending 40% more with everything going on with coronavirus. It's no longer a question on if taxes will be going higher in the future. It's a matter of how quickly they could. I think we'll see some clarity around some of this here in just a little less than a month. As we start to see how everything shakes out, you know, who's going to end up with the House, who's going to end up with the Senate, who's going to be our next president, and all of these things. But regardless of, I think, the direction that things go, whether it's all blue, all red, or some kind of Skittles pattern between those three areas, I think that there's no longer a question of if taxes are going higher, it's when. And when we understand that we've been told that we were going to be putting aside this money at a higher rate to take it out at lower, and that's not going to be the case, there's a huge opportunity there to be proactive in our retirement. And I think that's really why a lot of families end up working with secured retirement. They want to stay proactive. They want to not necessarily be reactive to retirement planning. They want to get the most from their retirement plan. So number one mistake we want to make sure that we're avoiding, or the tax planning mistakes, is making sure that you understand that taxes are probably not going to go down in retirement for most of you that are joining us today. They very well could go higher, and we're in a unique situation that we can do something about it. One of the biggest areas that we talk about that we want to spend some time on is number two mistake, is not having a strategy to reduce taxes around IRAs and 401ks. I was alluding to this earlier. A lot of times we find that we all want to be proactive. Think about it. Are you the kind of person that wants to take charge? They want to do something, or do you want to wait until as long as possible and then lose control over things? Well, if we're at 40-year lows and we recognize that these tax rates have to go higher, then we want to make sure that we are doing everything we can. And when you look at your retirement assets, the vast majority of families that we work with, it ends up being their IRAs, 401ks, these tax-deferred accounts. And what happens is you've been told, just like we'd put the money in at a higher rate and take it out at lower, the other thing we've been told is never to touch this money. You don't take it out if you are short for groceries one month. You just kind of, you don't take the family on vacations with this money. Leave the money growing as long as possible and don't ever touch it. And what happens is these 10,000 of us are retiring each and every day. We remember that we're not supposed to touch this money. So instead, we maybe take our Social Security right away. We take our pensions. We live off of savings or whatever. And then we let this money continue to defer until age 72. Most of you are aware that they changed the tax laws around required distributions last December, and they pushed that off to age 72. There isn't anybody listening here today that has to take a required distribution because of the CARES Act, which was passed around the COVID. But by not taking money out right now, or not putting together a strategy to start to spend some of this money, you could actually be missing a golden opportunity here. One of the questions that everybody should be asking themselves as they transition to retirement, am I better off taking some of my retirement account money, IRAs, 401ks, 403bs, should I spend that first and then hold off on Social Security benefits and take that at a higher amount? Or do I take my Social Security right away and continue to defer my 401k balance, knowing I might have to take more down the road but less up front? We can help you answer those questions, and they're all very important questions that we have to understand. But understand that your 401ks and your IRAs, these are the only assets you have. It's the only asset you have that the government actually tells us when we need to start selling it and spending it. The reason why is because of obviously they want to get taxed on it. many families, I'm always surprised, have never sat down and calculated what their required distributions are going to look like when they get to age 72. So think of your retirement account today. I know some of you joining us here are already taking out required distributions, but let's say that you're 60 years old. If you're 60 years old and you have $1 million in your IRA accounts, IRAs, 401ks, 403bs, how much is that money going to grow to between now and 72? Even if you spend a little bit of it, we have 12 years of growth, and it doesn't take that much of a return to probably get us to $2 million. Well, calculate for yourself what you believe your account balances are going to be at 72, and then take that balance times 4%. Now, technically at 72, the calculation's a little less than 4%, but by the time you're 74, you're taking out 4% of your money. By the time you're 80, you're taking 5%. So if we average and say that we're going to get 4%, has to come out of these accounts every year starting at 72. If my million turns into 2 million, that's $80,000 a year. And then ask yourself the next question, do I really plan on spending that much money? If not, if this is money you would rather continue to defer in the IRAs, then we need to start talking about how to put together a plan for you. Because if this $80,000 is money that you'd rather leave deferred, but you're going to be forced to take out, we need to start thinking about strategic ways that we can start to put you in better control of this money that we all know we're going to end up losing control of anyways. And again, because of the first point here, not recognizing that taxes are likely going to go higher, I think a lot of Americans are going to miss this opportunity. So it's important to us here at Secure Retirement that we do that. That's why we call our process the Tax Smart Retirement Program. And we can discuss that with you, or one of our advisors can go over that with you if you'd like to schedule some time to talk on the phone here after this webinar today. This week's Market Huddle. All right, let's go on to the third thing. The third thing is not understanding that you can pay taxes on up to 85% of your Social Security income. You know, when Franklin Roosevelt started Social Security, one of the ways that they actually got that to pass was by promising that you'd never pay tax on the income. It was always promised that Americans would not pay tax on this money. The money goes into the account. You're actually paying payroll tax on it when it goes in, and then they would say that they'd never pay tax on it going forward. Well, you know, about the 1976, 1977, Jimmy Carter was coming in as a president, and all of a sudden everybody started talking about how much trouble the Social Security Administration was going to get into. Remember these discussions? You know, it used to be 40 participants for every one recipient of Social Security. Now we're down to a little less than 3 folks putting into the system. Actually, with COVID, it could be a little less than that for every one recipient. And in 1983, Ronald Reagan made the difficult choice to start to tax some of our Social Security income. Well, in 1993, 10 years later, Bill Clinton increased that. And now most Americans are surprised to find out that up to 85% of the income they receive off of Social Security can be taxable. In fact, when they first started taxing Social Security, only 4%, 4% of the population even paid tax on Social Security. They've never indexed these numbers for inflation, and now we're over 40% are getting taxed, and that number is expected to go higher. The one thing that gets me, though, is because of the way the rules are written, and many people aren't aware of this, there isn't anybody that's joining us here on today's call that would ever have to pay tax on Social Security income if it was the only income you received in retirement. If that was the only income you needed and you could live off it, because of the way that Social Security calculation is called a provisional income, and if you sit down with our team, we'll make sure you know what this provisional income or where your provisional income is, and that helps determine how much of the Social Security benefits are going to be taxed. Because of the way that Social Security works, even families that are at $80,000 a year Social Security income, it'd be 100% tax-free if that's the only income you needed to survive. The problem is it's things like pensions or rental property or these required distributions. Back to point number 2, having a plan to take out your money from your 401ks and IRAs. It's these kinds of income that create taxes on that. And I believe with everything going on here with the COVID and everything else, I think that we're going to start to see even higher numbers. I would not be surprised to see us start to tax up to 100% of Social Security benefits when income gets to certain thresholds. I don't think that that threshold is going to be a $400,000 threshold, like one of the candidates is suggesting that they would not raise taxes on anybody above that. I think the threshold is going to be right where they start to pass on additional Medicare premiums. It's about $174,000 for a married couple. Individuals are about $85,000. So it's definitely something to kind of start to look at. Let us show you how we can get more from your Social Security benefits by bringing in some proactive tax planning. Like most of you have gone through that are clients of ours. Let's go on to the last bullet here. Today on the Market Huddle, we are talking about the 4 tax planning mistakes that can end up wrecking a retirement. Quick recap. First was expecting taxes to go down in retirement. In reality, they'll probably go higher. Number 2 is not putting together a plan on how to reduce taxes around your retirement accounts. The third one, as we just went over, not understanding how Social Security benefits are taxed and what we can do about it. And fourth and final for the week is not taking advantage of this unique opportunity. I said it earlier, we're at 40-year lows. We have more clarity now than probably any time in the last 20 or 30 years on the direction of taxes. They have to go higher. We've raised over $3.5 trillion of additional deficit. It's unprecedented how fast we have increased our national debt. The current tax rates that we're under are set to sunset already December 31st of 2025. So it's a foregone conclusion unless Congress were to make it permanent, which I just can't see happening. We're going to see taxes go back to where we were a couple years ago in just a few short years. And more than likely, depending on the outcome of this election and even the next one, we are going to maybe see taxes going higher sooner. So take the opportunity now. Put together a plan on how to start to get untaxed from our IRAs and 401ks. The Roth is a good option. There's other options too. Many of you are aware that we sometimes will use life insurance as a Roth alternative. It's kind of a Roth on steroids. But I think that if you understand that by taking and optimizing our current 401ks and IRAs, putting together a plan on how to move that systematically. I had a client in the office here just the other week. They actually moved over $500,000 from an IRA into a Roth IRA based on an article that they had read. And then when they got their taxes back, they were surprised on exactly how much they lost. They'd lost over 50% with everything, and now they're paying higher Medicare premiums. We got to have a plan on how to do this. So you got to make sure that you're doing it right. That's a lot of times where we can come into help with that. We go through that with our Tax Smart Retirement Program, and we can schedule 15 to 30 minutes. Again, this is open to anybody. If you're on the call today, or if you receive this as a recording by somebody that shared it with you after the call, feel free, give our office a call at 952-460-3260. Schedule your review. Another way we can do this is I'm about to start a you should see an offer there where you can just schedule directly on our calendars right now. Take a few minutes to do that. Schedule your call. I hope you got the value out of today. Our plan, we're moving here on Wednesday afternoon, Thursday, Friday. We'll be monitoring the phones the entire time. We just aren't going to do any face-to-face visits as we are going through the process. We'll make ourselves available if there's a crisis going on in anybody's lives. But feel free to give us a call if you have any questions. Again, we're going to be moving offices here Wednesday, Thursday, and Friday. And plan is to be right back next week on Monday and back with more market huddles. Let's see if I got a question here. I see that something. I got Jay. Thank you, Jay. I appreciate what you're saying there. Jay's kind of, I guess, giving a testimony. Keep in mind, I'm as a financial advisor, as a registered investment advisor, we're not allowed to post our own testimonials. But Jay, I appreciate the kind words you said. And everybody else, I hope you have the rest of your week. You have a great week, and I think we're going to get a little chillier. as we get near the end of the week. I think I saw highs even below 60. So it's we're starting to hit fall again real. But enjoy the fall colors while they're still out and before the snow falls and everything else. And again, we'll see you again next week on Monday. Everybody enjoy the rest of your week.